Hello, everyone. This is Ted Bauman here, editor of the Bauman Letter and of the Bauman Daily. We saw some really interesting action in the markets this week, and really, it's one of those things that, in hindsight, was probably predictable, but the cause of it wasn't. And I want to start by showing a couple of charts that actually illustrate what we saw in last week's, or rather in this week's Monday, the big jump. This is what happened on November 9th, which was Monday. We saw a 14% jump in the energy sector, 8% in financials, industrials up by 3, real estate 2.5, materials about the same. Overall, the S&P was up, but look who was down. Technology, communication services, consumer staples, oddly enough. Here's another chart that shows what everybody was calling it, market rotation. Here's some selected stocks. On Monday and Tuesday, Boeing, Chevron, Citigroup, General Electric, all up between 10 and 20%. Technology down pretty strongly, in some cases almost by 10%, but definitely not what we're used to. Now, this was anticipated, and in fact, I had been talking about the potential of a rotation away from technology and into cyclicals for a long time. Well, it's happened. But it hasn't lasted very long, and we got the reasoning wrong, or at least we ended up with a different reason from the one that we expected. Just to recap, what I've been saying for a while is that the markets had been anticipating, along with everybody else, thanks to the atrocious polling industry in the United States, that the Democrats would end up sweeping the White House, the Senate, and the House. And that would lead to dramatic fiscal stimulus, which would be bullish for cyclical stocks, the kinds of stocks that operate in the real economy, including domestic large cap manufacturers, energy, materials, etc., as well as mid caps and small caps. And so the logic was prepare yourself for that. Now, we know that that's not what came to pass, thanks to the people who split their ballots. We know that although President-elect Biden, and I'll call him that because I don't think there's any chance that that's not going to happen, is not going to be supported by a Senate. In fact, a lot of people split their ballots. They voted for him for president, and they voted for a Republican for senator, and that's why here in Georgia, for example, we're facing runoff elections. But the critical thing, I think, is that that means, and the market has accepted it, that we will have split government. That means that we can't expect anything like the level of fiscal stimulus that was anticipated. But there's another possibility, one that nobody really anticipated. It's one of those, I guess we're not going to call it a black swan, it's a white swan. It's a good thing. And that was the announcement of the efficacy of the Pfizer COVID-19 vaccine. Now, here's a chart that shows what happened over the course of the week. And I'm recording this on Thursday, as I always do, so obviously we don't know what's going to happen tomorrow. But this is a 4-week chart that shows the relationship between the NASDAQ 100, which is really the big boys, that includes the main technology companies in the U.S. market, compared to a couple of other indexes. One is the Dow Jones Industrial, that's the orange line. There's the Russell Small Cap Index, which is the red line. And then finally, an ETF of small caps. Now, look what happened. On the 9th, all of them up and the blue line down. And then we saw a reversal of those fortunes. We saw that essentially people thought, well, this is going to be good for us. We're headed back to happy days. But then they started selling off and rotating back into technology, albeit not quite at the same levels. So technology is kind of dawdling along, I think, where everybody's in waiting mode. So essentially what we got was a head fake, kind of like the kind of head fake that this guy, one of my favorite rugby players, used to use in his great career. Now, what that means is that the market initially reacted positively to the news of the virus, but then they stepped back and said, hang on, wait a minute, this vaccine has to be transported at minus 80 degrees Fahrenheit. How are we going to do that? How are we going to get it out there? How are we going to manufacture it? How are we going to move it in time to be able to actually make a difference? And then people started looking at the timelines. They started looking at who was going to get vaccinated first. And then they realized that in the context of what is effectively uncontrolled spread of the virus right now in the United States, and let's call it what it is uncontrolled. That means that we're headed for bad times before things get worse. And so the markets logically decided that their early bets on cyclicals were premature. In fact, that's exactly what they were. And so that raises the question of what comes next and what is needed to bring us out of the current situation. Now, forget about the politics. Let's just focus on what theoretically would be able to make up the slack. Now, I'm not talking about the long term. I'm not talking about where we will be from a year from now. I'm talking about the next quarter or so in terms of what's likely to happen in the stock market. And my thesis is that we need money spent by the federal government. And here's why. Here's a couple of readers who had a debate over the situation. Roberto says, I look disappointed in that trillions of dollars would flow into the economy. Brandon says it's not going to happen. And then Roberto replies, well, it doesn't matter. The Fed is printing money, et cetera, et cetera. And then Brandon makes, I think, the point of the day, which is printed money from the Fed doesn't end up in the economy. It ends up in the stock market, which is definitely not the same as the economy. Brandon, you're right. I think to this day, people still do not grasp the difference between the mechanism that the Fed uses to, in a sense, create more bank reserves to allow the banks to absorb more treasury bonds as the government runs up debts and so on, and the mechanism that actually gets money into the hands of people in the economy. So I'm not going to go to the details here, but fundamentally what we have seen throughout the entire period of qualitative easing right from 2009 onwards up until early this year with the CARES Act was a mechanism of monetary loosening, I guess you could say, that does not get to the real economy. It essentially focuses on the Fed taking longer-term dated treasury bonds and mortgage-backed securities out of the hands of banks and turning that, in exchange, turning that the value of those bonds into reserves for the banks, which increases their reserves levels, which theoretically makes it possible for them to make more loans. Of course, they don't make more loans because the economy has not been strong until 2019. It began to show signs of life. But this year, obviously, nobody's going to make any loans with COVID. And of course, people don't want to borrow money if they're not sure where their next paycheck's going to come from or if their business is going to survive. So again, that takes us back to the question of stimulus from the federal government. And I continue to maintain, and that is my main point for today, that stimulus is what is needed to get this economy going. And it's not going to come from anywhere except the federal government. Now, here's a chart that shows roughly the relationship between the different types of policy action that the Fed can undertake. It also includes a chart that shows government transfer payments, which are essentially unemployment, income support, welfare, whatever you want to call it, but basically the government paying out money to people. Now, it also includes a measure of deposits in commercial banks. Now, as you can see, during the financial crisis, the money that the Fed pumped out jumped dramatically at first. Then the Fed began to taper that off. That led to a tantrum in the stock markets. The Fed then raised again. Then it fell back again in 2013. And then essentially the Fed jacked it back up in 2014 and tried gradually to reduce from that point. And as you recall, during every time the Fed tried to reduce its quantitative easing activity, the stock market tended to react to it negatively. Then finally, again, focusing on the red line, we temporarily dipped into a negative territory with the Fed. And then in April this year, and March and April this year, the Fed's quantitative easing, its purchasing of assets from the banking sector in order to create more reserves for the banks jumped. That's the red line. Now look at the government transfer payments. Those also continued, they spiked a little bit during the crisis, but really nothing anywhere near the same level as the quantitative easing to the banks. And for that reason, because people were not getting support from government transfer payments, deposits in commercial banks, which is basically a proxy for how much money people have available to them, kind of dawdled along, didn't change very much. Certainly it didn't break from the historical trend. All of that changed dramatically at the beginning of this year. The blue line shows people getting money from federal transfer payments. So my point is that this was the very first time that, since the Federal Reserve has been involved in quantitative easing, that its activities, which are indirectly behind the government's ability to spend money, have actually reached average people. And the result of that was that instead of boosting inflation, of course, instead of boosting the economy, it replaced income that was being lost by the impact of COVID. Now, that's an important thing to remember. This is not extra income on top of what people already were getting. This was income replacement. People were getting paid money that they were losing in wages. They were getting paid in PPP loans that would allow them to keep their businesses open and pay their employees and so on. But that was all to replace income that was being lost as a result of the declining activity in the real economy. So that just goes to show you that that kind of stimulus can work in a crisis. In other words, it can put money into people's pockets. It can keep them going. Now, we know that that stimulus is running out. In fact, it has run out. There are still a lot of people on unemployment, but unemployment is starting to run out in many cases. And unless there are further top-ups to the unemployment funds in the states, it will be cut off within the next month or so for millions and millions of people. Now, that is the context, I think, in which people lost faith in the idea of a boom market, a bull market for cyclicals, when they realized that the Senate would remain in Republican hands. The virus vaccine idea came in, and that made people think, oh, well, this is a replacement. We don't need stimulus if everything's going to be back to normal in a couple of weeks. But now they realize it's not going to be a couple of weeks. So essentially, we're back to where we were. We're back to a situation where without stimulus, people have to ask themselves, where is the growth going to come from? I've argued consistently over a long period of time that the top stocks in the technology sector, the biggies on the NASDAQ 100, are overvalued. They don't have that much more room to run. I've advised, I think, initially when I thought that the polls were right and that there might be unified government, you could look to small caps and mid caps. But now I continue to argue that your only real bet for potential gains in the short term is going to come from emerging markets. Unless, of course, there are people are willing to continue to push up the price earnings ratios of tech companies to levels that really don't make any sense. But here's the bigger picture. This is a chart that, to me, is probably the most powerful illustration I've ever seen of what is wrong with the U.S. economy and why, unless we can get our act together politically, why we are facing continued challenges in trying to earn an honest return from the stock market without the Fed's intervention. The red line shows real GDP. The dotted line is the long-term trend line of that GDP. It's an exponential measure, and it shows what you would expect that trend line to do moving forward into the future. The blue line shows the potential GDP in the economy. Now, how do we get the notion of a potential GDP? Well, the Federal Reserve and other parts of the government regularly send out surveys of capital stock, surveys of labor activity, surveys of employment, etc. And from that, they can put together a fairly accurate picture of what the economy could be producing, given the amount of capital stock we have, given the amount of labor that we have in raw materials, and so on. Now, when the economy underperforms that means that there are underutilized resources in the economy. Now, remember, it's perfectly possible to have underutilized resources even with very low unemployment. For example, people who had jobs maybe as factory workers who end up driving for Uber. They're employed, so they don't show up in the unemployment statistics, but relative to their ability, the things that they could be doing, they are not producing to full capacity. You add all that up and you end up with a picture of the economy of what it could be if we were at full employment and full utilization of capital. Now, what you can see pretty clearly is that up until the 1970s, we were pretty much producing at capacity. Then, starting in the mid-70s and accelerating from the beginning of the 1980s, we began to fall under that. We began to see the trend line for the real economy, or rather the trend line for potential output falling underneath real output or above real output for quite a long time, which means that we're not living up to our potential. The gap grew at its widest, interestingly enough, during the early 2000s. Then we kind of caught up, but then the great financial crisis pushed us far below our potential. Now, right now, what's happening is that the blue line, the potential, is actually under the long-term actual trend line, which means that we are seeing disinvestment, lack of new investment in capital stock, lack of new investment in productive capacity in the economy, and therefore, even our potential output is not what it would have been if we had carried on along our previous trend. But even more alarming, the trend of GDP remains well below the previous trend line and also well below its actual output, the potential actual output. Now, what all this means, and this goes back to something that I have argued before, is that you may not like taxation, but ultimately in an economy where people are afraid to spend or unwilling to spend, either to consume goods or to invest in capital, invest in production, invest in new jobs, it means that everybody is holding back, and that means that the economy will underperform relative to its capacity. Everybody's waiting for something to happen. They're waiting for some spark to get the economy going again. That's a deflationary environment. It means that people are basically unwilling and unable to commit to put money into the economy, which means that it's a self-fulfilling prophecy. Things slow down. And under those circumstances, the only source of potential gain for the economy is either some external event like a war, like what happened at the end of the Great Depression, which forces the government to invest heavily in the economy, which gets things going, or for the government to pump money out in the form either of infrastructure or other kinds of transfers, either directly to people or through purchasing goods and services, i.e. Keynesian stimulus. Now, I've thought about this very carefully over the course of the last couple of weeks. A lot of people have pushed back. They're unwilling, I think, a lot of people, to understand what I'm actually getting at. It's not about whether you like taxes. It's about the fact that the only money that's available to kickstart the economy has to come from the federal government. My conclusion from this is that the head fake that we saw at the beginning of this week was based on the desperate notion that a vaccine would immediately solve our problems, and it's not going to do so. We know that. It's going to take a while. That means that we are going to continue to see underperformance in the kinds of stocks that would do well with the real economy strengthening. And so, therefore, I'm changing my prediction about small and mid caps and about cyclicals, because there's no justification for their doing well. If there would have been, if we were going to see significant federal government stimulus, now we're not. So I continue to say the best gains are going to come from offshore or from speculative gains in the top stocks. But make sure you call your tops, folks, because eventually we're going to hit them. Anyway, this is Ted Bauman signing off. I'll talk to you again next Wednesday. And don't forget, you can always subscribe to the Bauman Letter by clicking on the link below. Thank you. Bye-bye.